And Ron Bertino really needs no introduction. So here's Ron.
All right, thanks, Don. Hey, everyone. So yeah, I'm gonna, since we've got a fairly limited amount of time here, I'm going to go through this pretty quick and not spend much time on an intro, but for those of you that don't know who I am, I'm the founder of Trading Dominion. I've got a bunch of courses on trading. This one here is on option trading, advanced option trading. There's one on trading long-term type stuff, but it's kind of rotation strategies for stocks and ETFs. And then this is the new one for mining for gold, which has to do with data mining. So I'll just leave it at that and keep moving on.
Anyway, please tell us a little bit later on, maybe toward the, and by the way, we're not limited to a strict amount of time. So, don't worry too much about the time.
Sure. Okay. All right, so let me hide this thumbnail. All right, so I thought I would start off with covering some of the pain points that we face as discretionary traders, and then hopefully you'll see when we're done that we can basically address pretty much all of these pain points fairly effectively. But I think it's useful to kind of just point out what they are to start off with. So the first one here is lack of diversification across multiple instruments. And what I mean by that is that you might think of yourself as an option trader, let's just say, and then you say, all right, what are you trading? You might say, I trade, let's say, RUT, or I trade SPX, and that's it. Perfectly fine. You may trade, one or more strategies and so forth, and that's good to get some degree of diversification. But the reality is that, if you wanted to start to tap in through to ETFs and Forex markets and crypto and, international markets and whatever else that might be, futures and so forth, then it becomes very difficult because you've only got a set amount of time, a set amount of attention, a set amount of eyeballs in your head. So it's very hard to trade a lot of things. Okay. So that's definitely a pain point. Another one here is time to trade multiple strategies. And you might be fine trading maybe 2 or 3 different strategies, but once you really want to go beyond that, it again becomes very difficult to do things, let's just say conventionally. Lack of time to do intraday trading. I don't know if any of you have actually done day trading, true day trading. It is super stressful, okay? And you are glued to that screen. And the second that you've got to even go for a bathroom break or something like that, you're kind of freaking out that something's going to happen while you're away. So doing that kind of stuff manually is very, very difficult. If you have traded, you've probably noticed that you tend to react due to emotions. And unfortunately, we tend to react in the worst possible way at the worst possible time. And that degree of discretion can get in the way. So if you are able to trade fully mechanically, that's good. But some people that actually try to trade mechanically, then the emotions, of course, still get up in the way, if you like. And then even though they had a trade plan, they sometimes find it hard to follow that particular trade plan because, after all, it's a human that's actually making the decisions. Now, if you do move in through to algorithmic trading, some people have this kind of belief that, well, there's not really much you can do because the markets are random. You could have that belief, but I think that the data can kind of show that it's not entirely random. A big one here is not knowing how to code. And the presentation that you just saw here from Rocco is, it's fantastic to be able to get in through to Quant Connect and the infrastructure that they've built. The reality, though, is that to trade at that level, which gives you, it's let's just say the most advanced form of trading in the sense that you can completely control everything. The bad side of it, though, is that you have to learn advanced programming. Okay, we're not just talking about basic Python. You have to be very familiar with object-oriented Python, or if you want to get more speed, then you got to go into C#. And if you haven't done C# before, it takes 3 times as much code to do stuff in C# than it takes to do it in Python, as an example. So that can definitely be quite difficult. And like anything else, learning a fairly complex concept like programming in Python takes time, right? So you probably have to spend at least 6 months or so just doing nothing other than studying how to program. Now, if you didn't know how to code, then you may find that it's very easy to find strategies that have a very nice looking equity curve from a backtest, but then when you start trading that thing live, it doesn't look so pretty. So that is definitely an issue. So one of the important things that you have to learn is about how to go through validation steps in order to try to sift through the pretty graphs and really just get down through to the ones that hopefully are going to be the ones that actually are robust. But that is an important thing to learn as well. Related to that, the creation of systems that can be curve fit, very related to what I've just mentioned there. And this can actually be another one. So it's fine for me or anyone to tell you, hey, get into algorithmic trading, and you could, start off with something easy, such as, easy language from, TradeStation and multi-charts, where coding wise, it's ridiculously simple as compared to something like Python. But even still, you've got a whole bunch of other technology factors that come into it, right? So what are you going to use? Are you going to use your home computer? Well, that's probably not a great idea, right? Like, what if the power goes out? What if you lose your internet connection? What if you get hacked? What if there's a virus, right? So that is definitely an issue, and understanding how to put those technology pieces together in terms of, cloud providers, what pieces of software do you need? How does the software work? What are the things that can go wrong with the software? How do you recover from each one of those things? How do you monitor? How do you get out of positions? All that kind of stuff can be, let's just say, interesting, right, to consider. And then these last couple of points here is that there's, of course, just like with anything, there's, gurus out on the internet and TikTok these days that will claim that they can teach you, how to trade. And there's a ton of funny ones on TikTok, they say, well, just buy when the thing's going up and sell when it's going down. Hey, congrats. So the reality is that you really need to, find a mentor that has a proven track record. And hopefully that is not just them claiming that they have a track record, but something that can be validated. And at the same time, one of the things that you'll sometimes see out on the internet is that there are some gurus out there that basically claim that they've won a trading competition, or sometimes multiple times. That's great. The thing to keep in mind is that they're trading to win a competition. Okay, so the vast majority of the time, these gurus, if you ask them directly, will tell you they don't trade in real life the way that they would trade for winning this particular competition. You've got to be much more aggressive. You've got to be willing to basically lose your entire account and just go full out to either, blow past everybody else and win. And therefore you can now claim that you're, the winner of a competition, or you blow up and you just join the next year and try again. Okay, but that is not the way that you're going to be trading in real life. And they don't do that either, by the way. So to me, there's no point kind of potentially talking about that in terms of, winning awards and so forth, because it's not just the way that you're going to trade in real life. So let's get into some specifics, right, of how this stuff works. So what we're going to be looking at is something which is sometimes considered a dirty word almost, right? And it's the concept of data mining. And what we're basically going to be doing is that we are going to be using technology. Let me take a step back. The conventional way that everyone does it, including, what you've just seen from Rocco and any other strategy that's out there, is that you have to start with a strategy. So you've got to say, well, let's say that using technical analysis, right? You might say, well, what if I buy as soon as I get a close, above the, say, 50 period moving average, and then I'm simply going to then close that long position when we get a close underneath the 50 period moving average. Easily tested. But the key is that you've got to start with a concept, with a theory, with a strategy that you then code and you then see how it does. Okay. And there's obviously a billion different strategies that you can test, but the key is that you have to come up with that strategy, either yourself or from somewhere on the internet, a blog, a book, a trading journal, whatever that might be. This is different. This is the concept of saying we as humans are not going to be the ones that try and come up with a great new idea to actually test. What we're going to do is that we're going to let the computer do that for us. So what's going to happen is that we're going to start leveraging concepts such as AI and machine learning to allow the computer to go off and analyze all of the data that it can get a hold of. And what that actually looks like is price information. So think of things like open, high, low, close for each bar, but then indicators as well. So just like we can trade, discretionary basis for technical and use technical analysis, just like I said, using the 50 period or whatever that might be, you can you can have the technology that understands all those indicators. It's already pre-built into the technology. And you can say, you know what? I like the RSI, I like Bollinger Bands, I like moving averages, and I like ADX. Okay, so look at those indicators and experiment with them and test out any strategy you want with any kind of variation. And then out of all of those tests, show me the ones that match this criteria that I specifically set, and just show me those ones. Okay, that is basically the concept of data mining. But even though that's these days is actually very easy to do, and I'm going to be giving you a quick demo of a very powerful tool that we use as well to do the data mining, that is definitely not the end process. You cannot take those resulting strategies that are going to look beautiful and simply start trading them. Okay, there's a lot more to it, and this is basically what we're kind of looking at here. So the data mining portion is just, let me change colors. The data mining portion is really just this top section here. But even within that, we can start getting specific of what is it that we're actually going to look at and how. So things such as, you know, what are the actual indicators, right? Which time frame are we actually going to be looking at? And this time frame can basically say, you know, from this year to that year, but it can also be the time frame of the candles themselves, right? So are they going to be, you know, 1 hour candles? Are they going to be 30-minute candles? Are they going to be daily candles? And then as well as that, it's going to say we're going to go from this year up through to this particular year over here. Okay. Now from that, you are going to be blocking out that range of time that you are going to be looking at. And what you're going to do is that you're going to be dividing this thing up in through to what is typically called an in sample and out of sample. So for the in sample, what this is that when we tell the technology to just have some fun, go out and experiment, try everything that you can actually think of and produce something out of that. Okay, so let's pretend that it chooses, you know, 2 or 3 particular indicators, and now your equity curve kind of looks like this. And you say that looks pretty good. But then what the software is going to do now is that with the out of sample period, it's no longer going to be allowed to make any modifications within this period over here. Now what it's going to do is it's going to say, all right, well, for that particular thing that did well during that first sample over here, let's now test it in a different chunk of data, right? New fresh data, and then see how that thing does. And if this thing now basically goes like this, then you can choose to just throw that away as an example. Okay. So that is that. Then, you know, we have certain ways that we configure this initial time period. We have ways that we decide on how we create the split here between in sample and out of sample. We also have different chunks of time that we kind of put together as well. We look at them individually and combined, and we have certain criteria that has to match in terms of performance for all of the above. Okay. But that's just to give you an idea of the types of things that happen within this particular phase here of data mining. Now, beyond that, this section here is probably, I'd say, one of the most important ones, because what can happen is that we can start off with something such as, you know, just to pick a number, let's just say 1,500 strategies that have passed all of the check criteria that we have defined within the actual data mining step. And we end up with 1,500 of them. You might think that that's a lot, but once you start getting into this game, you realize it's actually not that many. But anyway, let's just say that you've got that as a resultant set from the data mining phase. Now what's going to happen is that you're going to go through a fairly detailed set of validations in order to try to hopefully figure out which are the strategies out of these guys over here that are hopefully robust. Okay, so to give you an idea of the types of things that you're going to do in there, so you might check different timeframes. So as an example, if you did, let's just say 1 hour checks on here in terms of the actual candle. Okay, so you data mined on 1 hour, you could go either down or up in terms of the time frame to a smaller candle size or a larger candle size, and use a different time frame over here as a way of trying to validate that. Okay. And if it passes, because this is essentially new data as well, if it passes this, then that should add some degree of credence, if you like, through to the fact that this might be more stable or more robust than other ones that don't pass this particular phase. Okay. So you've got, we've got the concept of different timeframes. We've got things such as looking at correlated tickers. So if you're looking at, let's just say SPY as an example, well, maybe you test it on IWM as well. If you're looking at Apple, then maybe you test it on Google or something like that, right? So you're looking at correlated tickers, and you can test it on the same time frame. So if this one over here is 1 hour, you might test it on 1 hour of the correlated tickers as well. You could, of course, also go up and down in terms of different timeframes as well, and then see if it passes all of those tests as well. Okay, and if it does, then that adds some validity to the fact that maybe this specific algo is going to be more robust than other ones that don't pass this particular phase, right? We look at things such as sometimes uncorrelated tickers as well, and if it passes the test on uncorrelated ones, that's actually, you know, really good, because it's actually quite rare. Then we can look at things such as Monte Carlo, and I'm not sure if I've got a time to actually get into it, but yeah, I'll be kind of very brief. Let's pretend that you do trade number one, and trade number one results in, you know, a win of say 1%. Then you do trade number two. Trade number two results in, let's say, a loss of 1%. Then you do the next one, and it's a win of 1.5%. And then you do the next one, it's a win of 2%, and so on. So we are going to be grabbing all of these returns and think of them as, you know, objects, right? Or marbles. Some people kind of say, imagine these guys are literally marbles. You then put all these marbles all into a container, and then you randomly pick any one of those marbles, which are existing returns that are based on real data, right? And you then pull it out. But what can happen is that the very first one that you pull out might be this one. So now it's a 1.5% return over here. The next one that you pull out over here is, say, this one over here. Now it's minus 1%. The next one that you pull out is this one over here. That's 1%. So what's happening is that you're getting a different sequence of the same returns that you actually had before. But this over here, it's still based on real data, real price data that you've actually got, but you're just randomizing, if you like, the sequencing of those returns. And Monte Carlo will do this hundreds of times and then show you the actual equity curves of all of those different sequences of returns, okay, and show you like a spaghetti graph, I tend to call it. And then there are ways, you know, we've got 4 or 5 specific things that we look at in order to eyeball this particular chart and then say that Monte Carlo graph looks good, or no, it doesn't look good, and we throw it away. Okay, so and there can be other things as well which kind of get fancy with their, you know, research papers and so forth, which are you don't need to fully understand, but the software has some pretty advanced extra functionality within the validation steps that you can actually do. And like I said, we've got like 8 or so different levels of validation tests that we do in this particular process, and we might go from, let's say, 1,500 in this phase that have passed all of the actual checks, right, that we actually go through. And then, but the time that we're actually done with these validations, which are automated validations, right, the software does all of this for us, we might come down through to say 20, all right? And that is a fairly big drop. And hopefully what we've done is that we've found, fingers crossed, the 20 strategies that are hopefully the most robust out of the ones that we started with over here, okay? Now, I should kind of focus a little bit on the fact that this thing here is automated. And this is one of the reasons that the software that I'll be demoing to you, called StrategyQuant, is really quite advanced. And what I mean by that is that if you look through to some other tools out there, you know, Build Alpha or GSB and some others out there that do the same kind of concept of data mining, the problem with them, with some of them anyway, is that they're fine as tools, but they can only do one of these things. They can do any one of all of these things over here, but you have to do each one individually yourself, okay? Whereas what we can do with StrategyQuant is that we can create a workflow and say, do this first, and then so as an example, this is step one over here, where we say, do all of these things and all of these checks, and the algo must hit all of these performance criteria levels and so on. Once that's done, then pass it along through to the next guy that's in my actual workflow. This is validation step one. Then out of, and it wouldn't be down to 20, but let's pretend it goes from 1,500 to, I don't know, 1,000, okay? Then from there you say, when this is done, then pass that on through to validation 2. When that's done, pass it on to validation 3, and so on and so on and so on, okay? So the workflow aspect of StrategyQuant is a huge time saver, okay? And I'm being quite literal there. We used to do things manually with some of these other tools, and it would take sometimes hours of work. And we can now be in a position where, even though it may take a decent amount of time, even if it is hours, you don't have to be the one doing it, right? It's the computer that does it for you. So you just click a button, walk off, go have your coffee, come back, and when you come back, it's all done. So that is a huge boost to productivity, okay? Next one is that once that's complete, we then go through a series of steps for manual validations. So the software, as good as it is as good as it is. Okay, so in our belief, there are still manual things that we can do. We can just eyeball some charts and look for specific criteria, and from that basically be able to say, nope, don't like it, throw it away. Nope, don't like it, throw it away. Okay, so you've got manual validations that can happen there. From there, then we go into portfolio construction. Portfolio construction is the concept that we might end up with, let's just say, and this actually has a couple of things kind of layered in, but let's pretend that we've got, I don't know, let's say 10 algos on Apple. And when we're looking at these 10 algos for Apple, it's the same ticker, right? One of the things that you might be sometimes surprised to see is that you might think, well, it's Apple, it's the same underlying, it's the same ticker. So clearly these 10 algos are going to be very highly correlated to one another. Okay, you might have an expectation, the correlation might be, 90% or something. You'd expect it to be super high. The reality is that that's not necessarily the case. And we regularly see certain algos, let's pretend that you had these 10, we might have algos that have a correlation of something like 20%, which is very low. Okay, so if you have that, then you might say, well, you know what, out of these 10, I only want to choose 2 algos for Apple, but I want the 2 that are the least correlated to one another. Okay. Related to that is that once you get into this, you'll not only be mining a single ticker, you're going to be mining a whole pile of stuff, right? And going back to the pain points, there's really no limit through to what you can mine. You can mine any ticker that you've got access to data for, any time frame, with almost any indicator. That is a heck of a lot of data, right? And what's going to happen is that now, for example, you've got 2 algos that have very low correlation to one another, and they're based on the same ticker. But then you go out and you look at, say, Tesla, and you pick 2 algos from there that are lowly correlated to one another. But then hopefully, once you have a series of tickers here, so you've got 2 for another ticker, 2 for another ticker, now you're looking at this in combination, and now you're also looking to choose algos that the correlations between these guys are low as well, because that's ideally what we want. We want uncorrelated or lowly correlated return streams, and putting them together, we can get a really nice smooth equity curve, right? When we look at everything together. Now, from there, we're still not done, because what if we end up, even to say with 2 algos that we like, that's passed all of these actual tests, okay? The reality is that we still don't want to blindly trust what the software is telling us should be robust. So what's going to happen is that when we've got these 2 algos, let's say from Apple, and of course we've got 2 from say Tesla, and whatever else they are actually data mining, these could be futures and whatever else that might be. When you have that, then what we want to do is we want to put this into the incubation phase, which basically just means paper trading. And we want to keep an eye on things, and we want to now validate that, yeah, hopefully all of the work that we've actually done, we find that when we actually trade this, paper trade it live, that it's still performing adequately. Okay. Now, this also requires criteria, though, because what happens is that let's pretend that you look at any one algo, and let's pretend that it's some kind of equity curve that looks like that. Then from there, let's say that now we start to live paper trade. Well, ideally, it basically just keeps going like that, right? So in other words, the trend, if you had to draw a line or a regression line through it, is identical to what it was. But in the real world, it may not be like that, right? It might be something like that. So the slope is less than it was before. So there are questions then to answer in terms of saying, well, how much of a steepness decline are we willing to allow? And what if the algo actually just takes a loss? Does this imply that we would never trade this? Okay. Those are the kinds of things that just, take experience and knowledge in order to figure out in terms of saying, well, am I going to throw this guy away or am I actually going to keep it? Right. And we have boundaries that are there's no discretion involved here, right? There are specific math-based boundaries that allow us to say, well, during the incubation phase, when we look at this equity curve, is it normal based on what has happened historically or not? And there is a very specific line in the sand that if it goes below this particular level, we throw it away. It does not pass incubation, and therefore we will not trade it actually live. Okay. The other aspect of incubation is the amount of time or the amount of trades that you're going to spend in this particular phase. So as an example, some people might say, 3 months or 6 months, whatever that might be, of incubation, that it needs to prove itself that yes, during live paper trading, it's actually performing adequately, right? Another way to do that is basically say, well, even though, let's just say you can't just have a blanket statement of saying 2 months or 3 months or whatever that might be, you could simply say X amount of trades. So you might say, well, if it passes, let's just say 30 trades, and the performance is adequate, that we consider it to be normal, right? Even if it might be kind of going flat during a rough period, if the market's actually going down and, you're trading Apple long, right? And let's just say, SPX is doing this from this particular period, and your algo is doing this, well, your algo is outperforming the market. So that actually can be potentially perfectly fine. Okay. So now, of course, you would want your algo to be able to do this, but it's not realistic, right? If it's going to be just a long only algo, definitely not. If this period over here was, super bullish, you're not going to get that when the market is tanking, right? But what you want to see is that you want to see the algo outperforming the market here at a minimum. So that is incubation. So we prove, we don't hope, right? We need to see proof that yes, it is robust by paper trading it. And then once it's passed all of the validation tests, once it's passed all of the actual incubation phase, only at that point do we go live. But there are also things that you need to be aware of here. So that, everything from, execution issues, such as, what happens if your trading platform just dies or freezes or powers off, or you lose your internet connection, right? You need to know all of the scenarios of what can happen and how to recover from those scenarios. You've got things such as knowing the levels at which you're basically going to bail out of that particular algo. Okay, you need specific lines in the sand so that there's no discretion involved, right? You want to try and remove emotions from every level of your trading, if at all possible. And then, of course, there's things such as monitoring your positions so that you know how and when to monitor the daily P&L levels and so on, right? Just for your own sanity as well. But, not just for your own sanity or, greed or fear or whatever that might be, but it's also to make sure that things are working correctly. So sometimes what can happen is that you can have the technology sometimes double up your trade without you realizing it. It's just something that the platform did accidentally. So that's something that you need to be aware of and that you definitely want to be checking at least on a daily basis. Okay, so it's not completely unlike what some people may be teaching on the internet. You press a button, you walk off, for a month and you just let the computer do everything. That's just not reality. You still do need to check things, but you don't need to be glued to the computer. Okay, if you're checking things on a daily basis, let's just say, that's perfectly fine, perfectly viable. All right, so that's basically the methodology. And what is very interesting about this specific tool, which is StrategyQuant, is that when it does all of that work, and it does a lot of powerful stuff. But at the end of that, you can simply go through to the source code tab, choose the language that you want. It is a limited set of languages. So in this case, it's easy language, which is for TradeStation or for multi-charts. But you can see that it basically gives you the actual code. So you don't need to learn programming at all going in through to what, in this case, for our course, or if you choose to just use the tool on your own, when you're using StrategyQuant, you don't need to learn anything. You don't need to learn Python, but you don't even need to learn easy language itself. Okay. It creates a code for you. You simply come here, copy that code, paste that code, then in through to either TradeStation or multi-charts, and that's it. From there, the thing basically just runs itself, right? All of the code is pre-written for you. You don't need to spend any time learning to program at all. So I was asked to give a quick SQX demo, so let's do that. All right, so here's SQX. So I'll run through very quickly because it's some pretty advanced technology here, but I just want to give you a feel for how this thing works. And so here, basically, I'm going into the builder, and the builder is what's going to be, think of that as the first step that we looked at, which was the data mining phase. So from here, I can go in through to my full settings. And let me start from the start. All right, so from here, I can say something here. I'm basically just saying simple strategy, which is what you would think, right? Just go in and find me an algo for Apple, let's just say. This option over here is the concept of saying, find me an algo that trades on the hourly time frame, but that also validates the trend on a daily time frame. Okay, so that is for doing multiple time frame strategies or multi-symbol strategies. So you might say, I want to, go long on SPY as long as, say, VIX is down versus yesterday, right? Something like that. So multi-symbol style strategy. Strategy from a template. This is where you can define your own pre-configured template, and you can think of this primarily as the use of filters. Okay, so let's say that you want to allow StrategyQuant freedom to find an algo for you based on, say, 5 different indicators that you like. But at the same time, you might say, well, you know what? I only want to restrict you to going long, let's just say, when the price of the actual ticker is above, let's say, the 200-period moving average. Okay, so it's kind of like an interesting hybrid where you give it a set of restrictions that it has to work within, but from there, it has full freedom to explore using the building blocks or the indicators that you've told it that it can choose, and just to go crazy as long as it's meeting your predefined criteria of trading above the 200-period moving average. Okay, vice versa, you could flip that over to basically say, if I'm going to be looking for a short only algo, then I'm going to restrict you to only look at something when it's trading below the 200-period moving average. Okay, so that's what that is used for. I'll skip over the improved stuff. So from here, you can have the option to choose if you want to, for the algo to both go long and short, or if you want to restrict it through to one or the other. Typically, we personally tend to restrict it. There's nothing saying that you can't go short. It's just do a different build for the short as opposed to the one that's long. Okay, we find that the algos tend to be more suited through to a certain direction in general. So the build mode, this thing over here, you've got the concept of random generation, which basically just means out of the things that I'll tell you that you can experiment with, just go crazy. Test anything you like, any setting, and any of the indicators that I've told you can use, go for it. Okay, that's random. Genetic evolution is a pretty interesting way to do it as well, which it's not purely random. The very first selection will be random, but then thereafter, what it's going to do, it's going to use the concept of just like human or animal evolution, right? Darwinian style things where you say, I will allow you to make a change through to a particular variable, but then it looks at the so-called fitness of the results and then it picks the ones that are fittest and removes the ones that are not doing that well, but then it keeps evolving the most fit strategies, and then it starts branching off into sub branches and so on, and then that's how it determines the final strategy. Okay, and there are certain instances that you want to use random, and there are other instances that you want to use genetic. This one over here allows you to actually limit the number of entry criteria. So you can say, you know, I want to set this through to up to a maximum of 5 different conditions, and for exit, I want to set it to a maximum of, say, you know, 3, from 1 to 3, whatever that might be. You've got full choice there, and you can also then go in and set how the stop loss is actually going to work, where you could say if it's the stop loss is actually required. So in other words, I want every single algo that it comes up with, it must have a stop loss. There is no choice. It must be there. Okay. And then you can choose some starting criteria that it can use for that stop, and exactly the same thing for profit targets. Okay. Next one here is where we define the actual data. So kind of taking a step back, if I go through to this data manager, from here, you've got to start off with defining an instrument first. And this is primarily where, it's more appropriate or relevant, if you like, through to futures primarily, because futures have different big point values and tick values and so forth. So that's why you have to define them over here as an instrument. Whereas if you're just trading, ETFs and stocks, then, you can just define a single thing over here, which basically is, $1 a point, and it's pretty straightforward. And typically, 1 cent ticks between those particular steps. So you define your instruments. From there, you go in and then you define the symbol or the ticker that is linked through to the instrument that you've defined back in this panel over here. And when that's done, you then import actual price data in there. And you can see here, here, these are futures, and I've got some stocks, different timeframes and whatever, but then you can see clearly, it's trading from 2004 up until, January 2022 in this particular case, and it tells you total days, total records, blah, blah, blah. One of the pretty cool things about StrategyQuant as well is that you can obviously have a fair degree of freedom in terms of where you source your data from. There's dozens and dozens of different providers, and one of the nice things here is that when you import your data in, StrategyQuant actually has built-in tools over here. So if I go to tools, I can go to this thing called View and Analyze, and what it's going to do is that it's going to look through all of your data. But then if you go through this analyze data quality, basically green is good, red is bad. Okay, so if you see little things like this, or you get little red ticks here and there, that's perfectly fine. But sometimes when you import some data from a data feed provider, you'll see that this thing, or it may not be totally red, but maybe say from 2005 to 2010, it's almost completely red, and thereafter it's nicely green like this with very, very little red. If that's the case, then you know that you just have to throw away and not use, those first 5 years. But the cool thing is that, at a glance, you can just look at this and just see the quality of the data. Okay. That said, you can import, depending on which version of SQX you buy. If you buy the ultimate edition of SQX, you'll be able to suck down data both for futures and for equity directly from SQX. Okay, but you can see from here, if you're trading Forex, you can get stuff from, Dukascopy, you get it from Darwinex. If you're trading crypto, you can get it from here, right, with Binance. You could also get stock data here from Yahoo, which is all free. So, but when you do this kind of stuff and then you look at the data quality, you'll find, sometimes it's not particularly great, especially when compared through to a good data provider, such as, say, TradeStation. Right, so all of the information that I'm using here is all pulled from TradeStation, which is, in my opinion, at least, one of the best data sources out there in terms of quality of the actual data. So once you've got that, if I go back to Builder, this thing over here is now going to say, all right, well, which symbol out of the ones that I had defined over here in Data Manager do you actually want? Which time frame? What data range do you want? And what type of candle do you want here? Okay, so you define that. You can define which engine. You can see which engine they support here. So TradeStation, Multicharts, J4X, or MetaTrader, the main ones. But here I'm just using TradeStation. And you can define slippage. All right, spreads are not particularly, spreads are more relevant through to Forex, but you can definitely define your commissions and your slippage there. You can then define your in-sample and out-of-sample periods, which I've already kind of covered. And you've got some, predefined sets that you can choose from up here, or you can create your own, right, by clicking on Add New Part. So that's that part there. Then over here, we've got trading options. Trading options are some simple things that you can turn on and off. So as an example, if you're trading, you don't want to have a weekend risk, you could simply turn this guy over here on, which says, sorry, wrong one, exit on Friday. Okay. And therefore you're not going to have any weekend risk. If you're doing an intra-day trade or, day trading kind of concept, you might say, I want to force the algo to exit at the end of the actual day. I don't want overnight risk. Okay. So you can turn this guy on and various other things that you can very easily turn on and off from there. Another interesting one here is session. So if you're trading futures, as an example, you might say, even though futures trade almost 24 hours a day, then I don't want to trade anything other than the regular session. I don't want the extended session. Okay, so you can go in and define your own custom session and then limit that session through to the regular trading hours there. Building blocks is where you define, think of this as the indicators, right? As a matter of fact, let me go there first. So if I go here, you can see that we've got indicators, right? So you've got ADX, you can see here, average true range, Bollinger Bands. Let me scroll through these so you can get a eyeball on them, right? Common ones, right? CCI, fibs, even, which is interesting, various types of moving averages, Keltner channels, MACD, momentum, a whole pile of stuff, right? And these are basically all of the indicators that are built in to the platform, and there's quite a few, right? So you can select whatever you want there. Or you can go through to these signals, and this is just kind of like certain criteria that it's looking for within a particular indicator. So you can see here, this one over here says ADX changes direction upwards. So ADX is currently going down. If it now changes direction upwards, I want that as a signal. So you can select that, and there are tons that you can choose from in there as well. Right? Now I'm going to show you a shortcut as well. And that is, you might say, well, that's a lot of stuff to choose. How do I know what to actually choose? Well, that is part of what a degree of experience and knowledge actually comes in. But if you kind of want an easy starting point, you can go back through to this progress tab over here, and then go to this predefined config, and then say, well, I want to do a trend following strategy. And this is built into SQX, right? Or I want to do a mean reversal strategy. And this is SQX basically just saying, all right, fine, let us pick stuff for you just to give you a starting point. And from there, you can tweak things. And now if I go to full settings, now they've pre-selected all of the particular things. They're not selecting indicators, but you can see here in this particular case, they're using just these signals that you see there, right? I can click on this little checkbox that tells me just the stuff that they've actually selected for that. So these are, again, indicator concepts. Here you can check between the different types of orders that you can go with. So here they've selected market orders and stop orders, but not limit orders, which has a degree of wisdom built into that, which I can't get into right now. But then we've got some exits. So you can see here, they're basically saying, let's exit after X amount of bars. So, it might be 2 bars or 5 bars or 4 bars, whatever that is, that you can customize it by going into here. Or here, they're basically saying, move the stop loss to break even after a certain point. They're forcing a profit target and a stop loss because it's under the required column. Okay, so that's basically all that. ATM is an experimental feature, which, since it's experimental, there's no point for us to talk about. Then for money management, this is where you basically do sizing. So from here, this is an example. If I basically say stock size by price with balance turned off here, what this has the effect of doing is doing a $25,000 trade every single time. Okay, a fixed amount of capital, and therefore you're buying a different amount of shares, but you're keeping the capital per trade constant, right? Then over here, we've got a bunch of cross checks. So think of this as validation. So you can see here that this particular thing had Monte Carlo turned on with various tests. They're also doing a higher precision back test. But I will just scroll through. You can see that there's some other things that you can do in there, right? Including things like walk forwards and walk forward matrices as well that you can do as well. And then under ranking, this is where you define how many total algos do you want in this phase, which is the data mining phase. before it stops. In this case, they've selected to mine 1,000 strategies. Okay, they're going to rank that based on the fitness, if you like, which is return to drawdown ratio, and then the criteria that they've selected with that predefined filter that you saw me do is that the net profit for the in-sample period has to be greater than 50 here, and then the number of trades during the in-sample period also has to be greater than 50 trades, right? So from there, you basically go and click on start. And now this is where the computer starts doing all the work for you, okay, during this particular data mining phase. Now, if you look at this section over here, you start to get some degree of feedback as to what's going on. One of the things that you can do here is that you can click on where it says rejected for detailed, you can click on that. And then this is now going to start saying, well, out of all the criteria that you've actually defined, these are the counts of the algos that are being dropped because they don't meet a particular criteria. So you can see that the most common thing or criteria for which something is being dropped is because it's not passing the Monte Carlo test that this particular build has defined, right? But you can see that and kind of keep an eye on that. And then as it data mines, we can open up this section down here, which is you'll see that this starts to fill in as time goes by. And these are the algos that passed all of the criteria that you defined within your workflow. So again, to repeat, if I go to full settings and ranking, this is the criteria that we're saying has to pass, okay? But also in this particular case, there's also a couple of cross checks, okay? But if it passes all of that, then it gets through to this phase over here and it'll appear in this data bank. And right now I've got 5 records, but this will keep going up until it finds 1,000, okay? And that is basically step 1. So that's already quite a lot of work, and this can take hours and sometimes even days, all right? Depending on how easy or tough it might be for something to actually data mine that particular ticker. But again, the big power of this software is not just in this first step. The big power is in the concept of doing workflows. So here, if you go to custom projects, if I click on create new project and then call this test, right, you can see it's created a new workflow. And if I go in through to that, it starts off with nothing here, but I can now click on add new task. And the first step that I'm typically going to do is a build strategy, which matches, let me close this guy off, right? So you can see that it looks exactly the same as the build step that we did before, okay, with all of the same tabs and everything. But we've now defined that just simply as step 1 in a multi-step workflow. So from there, I can now click on add new task and then basically say, well, I then want to do a retest. So in other words, I then want to add some validation tests that it must pass. And you can see there's the whole pile of extra stuff that I can actually add and create a workflow as complex as you actually want. In the course we teach, you'll basically find that we have roughly about a 10-step workflow that we go through. And like I explained before, everything that passes from here is then passed on to the next step, and that gets filtered down, and then those are passed on to the next step, and so on and so on and so on. By the time that you get through to step 10, then those are hopefully the most robust strategies that we've got. And remember that we then go through visual or manual eyeball checks, right, with certain criteria, and then we incubate, and then we go live, okay? So that is a quick overview of StrategyQuant, right? Very, very powerful software. In our opinion, it's the best data miner technology that's out there, primarily as well because of the workflow capabilities that it has. All right, so I'm just going to stop this guy here. And I should also note that obviously the more beef you can give to the machine, right? The beefier it is in terms of CPU, especially, not so much RAM, but it really does use as much CPU as you want to give it, okay? This particular machine that I'm running is quite beefy. So it's, I'll show you here. All right, so this one here is 32 vCPUs and 128 gigs RAM, right? So that's pretty beefy. And as part of what you learn as well is that for those of you that have looked at, Google and Amazon for buying compute from those cloud providers, a box like this would be ridiculously expensive. Okay. But we've got some providers that we work with that it is like this system here, as beefy as it is, I'm basically paying $100 a month for it. That's it. Right. So, and if you don't want to go as big as this, obviously you could get it for cheaper than that. So that is that. All right. So that's the XWix demo. How are we doing for time? Okay, we're almost at the hour. So let me keep trying to add value here. So I'll walk you through a couple of configurations, and this is part of what I was getting at in terms of the technology has to be kind of put together in order to make all this kind of stuff work. So you'll see here, this is the simplest way to start off with, and the way that we would recommend to start off with when you're getting into algorithmic trading, and that is that you have either your local computer or ideally a virtual private server at a cloud provider, similar to what I just showed. All you've got to do is install TradeStation on that machine, and then you sign up to TradeStation as your broker as well. And now you get all of the really high quality data getting pulled through to your machine from TradeStation, and at the same time, you're sending all your orders through to TradeStation. But a big benefit is the fact that since this is the same entity that runs your algos, that runs your data, and runs all of your positions, the technology has the ability to make life easier. Okay, so as an example, it can do things like match up what your algos think you should have as opposed to what you actually have, because they can see both, right? And that alone is quite a big benefit. Now, if you didn't want to be with TradeStation as a broker for whatever reason, then there are other models. So you can see here, you could do something such as now you would have TradeStation over here to essentially act as your endpoint for sucking your data in from TradeStation, but you're now using them just as a data provider, not as a broker, okay, just a data provider. And from there, your main technology could be running multi-charts in the back end here. Instead of running the algos on TradeStation, you're now running the algos on multi-charts. Multi-charts can then connect through to IB Gateway, and then IB Gateway connects through to interactive brokers. Okay, so this is a fairly popular model if you want to trade with IB. There's another model as well here, which is kind of different, right? But similar at the same time. So you're still using TradeStation as your data feed provider, but notice there's no more multi-charts here, right? Some people, for some reason, don't like multi-charts, and that's fine. If that's the case, what you can do to still get access through to sending your orders through to interactive brokers is you can use this other technology here called NinjaTrader. You do need the paid version though, right? So, but you can use NinjaTrader essentially as a bridge. So TradeStation now sends the orders through to Ninja. Ninja then interacts with IB Gateway, and the gateway then sends it off through to IB. Okay. So if you're in a situation, especially if you already own NinjaTrader and you don't want to have to buy any other software, then at that point you can say, well, I'm not going to do this prior model because this would need me to buy multi-charts. So I'm just going to use this model here because I already own Ninja. Okay. And I can basically just use it as a bridge in order to interact with IB. For those of you that are on TDA, you can still use this bridge concept over here to also send your orders through to TD Ameritrade as well. Okay, so those are the 3 or 4 different most popular models. There's obviously more that you can have, but I would say to keep these ones here in mind. They're the most common, but I would also encourage you to start here, right? By far the simplest and potentially the most powerful as well in terms of stability and monitoring and so on. All right, so very quickly looking at live trading performance, because we talked about, you want to be learning from someone that's actually doing this for real. And I'll actually explain what's happened here, but I basically paired up with a trader from my own community, a guy called Now. He's actually on this meeting too, so he'll be available during the Q&A section at the end. But this is his real live trading performance of his real account, not for a competition, real trading performance. Okay, this is being pulled directly from his interactive brokers reports. And you can see here in 2019, he basically, this is, they call it VAMI, but it's really just an index that starts at 1,000. And this is not dollars, obviously, right? But it's an index just to show you the actual performance. And here we're looking at the green line here is what SPX was doing during that year. And then the blue line is his trading systems combined. When you're asking, well, what is that specifically in terms of, how many algos does that consist of? now tends to trade typically between say 40 to 80 different algos at the same time. Okay. In this particular case, it was, largely based on stocks, but he was also doing a bit of futures. But that is essentially what was going on. But you can see here that, pretty awesome return here of 89.5%. And again, this is after all costs, after everything. This is net. Okay. 89% return that he got out of 2019. Then here's the performance that he did in 2020. Again, all real trades, right? But you can see that the VAMI on his thing is at 72.9% for that particular year, and how it compares through to the underlying index there of SPX. It's 2020. Then here's 2021. Slight change. Just notice here that he's basically comparing it through the Qs. And you can see here that in 2021, he got 79%, which again is pretty damn amazing. For those of you that know me personally, I tend to try to have a target of things that, we trade within our community. We really try and go for, say, 20% a year on your entire account. Okay. If you're performing at that level, you're performing at Warren Buffett levels. Okay. And he's considered like the god. So, all right. So if you can consistently do that, you are trading at the level of the best of the best. Okay. Now, of course, you can have a good year, but the key is to be able to do that consistently. So, I want to put that into perspective, right? I'm not trying to make a claim that, when you get into it, you should be aiming to, hit 80% returns every year. That's obviously very, very high. A 20% target on return on your entire account, I think is a really, really good thing. It's not, it's very, doable, but at the same time, you are going to be beating the pants of all of the major hedge funds out there if you can do that consistently. Okay. And so here's the combined 2019 to 2021 performance over 3 years. Again, 462% over 3 years, which is pretty amazing. And, almost 2,500 trades, live trades. And then you can see here how it compares with the underlying index there of SPX. You're probably saying, okay, but what about 2022? All right, because we've been in a bearish market pretty much all year. Well, here's his 2022. And you can see here that during this particular period, and this is mainly long-only stock trades, okay? During the first 7 months here, he's basically at minus 3.4%. You might say, well, he didn't pull a profit. Well, number one, it's 7 months. We still have, more time to go. We're only about halfway through the year. But on top of that, and this is part of what I was kind of alluding to before, right, is that, of course, the market is going to have some periods where it's going to be going down, but does your algo outperform the market? So if during bad times, you can see here, right, the market based on this VAMI index here is almost at the, 80% level. So in other words, it's down 20%. And this is up until now, right? This is up until the end of July. So if the market is down year to date 20% based on this index here, which is tracking the Qs, and he's essentially almost back to break even, now he's outperforming the market by almost 20%. That's what you want to see. Okay. So performance, I think, is fairly impressive. And again, this is all real trading, live and independently tracked. Okay. And you guys can all go to this link down here, right, which you can see on the screen. If you want, I can post them in the chat as well. And this is hooking into his live accounts. So you can see it even on a daily basis, exactly what he's trading, right? Nothing is hidden. And you can see the last 4 years, right? Over 3,100 trades tracked over a 4-year period. And again, over the last 4 years, he's done, this is in dollars, which I don't think is great, right? But really all you're doing here is you're basically just looking at the shape of the equity curve primarily, right? But that is still pretty, I think, impressive at doing, 460% return over the past 4 years or so. And for this year, basically being break even when the market is still down 20%. All right, so almost done. So with the course, I also had some people saying if they could take a peek behind the curtain. So
yeah, please tell us a little bit about your course.
Sure, I'll
and
hopefully
including the, the fees and what's included.
Yep. So I'll just quickly kind of show you the inside, right? So from here, you got to start from strong basics, right? In terms of you have to understand, how returns work, and there's a bunch of stuff in there about measuring risk. There's a bunch of stuff in there. Then we start getting through to some of the technology type stuff in terms of for hosting. Okay, so and there are full walk step-by-step guides on exactly which VPS providers or dedicated providers to use and how to install everything, right? Including manual installations of the operating system step by step, because if you do that, you can basically get stuff cheap. Okay, because instead of renting a full license of Windows, as an example, you could in theory bring your own license legally, and then from there things end up being cheaper. So, but it is a little bit technical. But again, there are full walkthrough step-by-step guides that take you through all of that, and that includes not just setting up the VPS, but also setting up your software, right? So it's how to set up TradeStation properly with all the settings or multi-charts and so on. A whole bunch of stuff on getting historical data, how to use the analyze feature, how to compare different providers and so forth. The providers we recommend, again, I've already mentioned to you that TradeStation has excellent quality data. So, but there's still stuff that you need to learn from that aspect. Then there's preparation type stuff that you need to learn from a theoretical perspective when we start getting into the StrategyQuant. And then we get into all the StrategyQuant type stuff, right? And again, all the multiple timeframes, Monte Carlo, correlations, data mining aspects, right? Steps for manual strategy review. Then we start looking at I mentioned to you before that you can create filters, right? If you recall, you can then define your own custom template and then link that through to SQX, so that SQX can now say, I can now data mine, but within your restrictions that you've defined. Okay, and that is what this section over here covers there. Then there's certain tools that we use for doing portfolio level analysis. Some tools actually come with StrategyQuant itself, called Quant Analyzer, which is really good. But some tools are also, you could leverage tools from TradeStation and also multi-charts as well for doing that kind of stuff. Then technology specific stuff here on multi-charts, getting all that working. Then a whole pile of stuff on execution issues that we talked about before, right? So what happens when, like over here, right? So what happens when you literally just turn the lights out? So simulating, turning off the power on your entire house, as an example. What's going to happen when you turn it back on, right? Clean shutdowns, dirty shutdowns, right? Jumping in late into trades, adopting positions, combining things together, monitoring things, right? Then what happens for, going live with incubation, addressing some bugs, with that we found, various discounts to various entities there, and then some group meetings. So these group meetings over here are sessions that we've had with Now that comes in to answer all questions, and he is the trader that came up with all of these concepts. I've basically wrapped his concepts in through to lessons which hopefully are clear and understandable for the actual course. And like I said, he is actually available in this meeting now. So Don, his name is Naufel Tayef. If you want to meet him as well, then he can jump on. But that is a course. Now, in terms of what I'd recommend, if you want to learn more about the course, if you go through to, if you go back through to my sites, just Trading Dominion, from here, click on the Mining for Gold course. And then if you scroll down, this thing over here, if you click on play here, you can see this is a 3-hour presentation. Whoops, right? That's a 3-hour presentation that we go through everything. There's a very, very detailed Q&A section at the end as well. So I'd recommend watching this, okay? And that will hopefully give you a lot of answers, perhaps to questions you might have. And from there, you can make an informed decision whether this course is right for you. All right. So questions?
It's not that expensive, is that right, Ron?
Look, the software, the course is, and this is part of why I'd like people to kind of go through this presentation, right? But
Okay.
it's not like I'm trying to hide anything, but I want people to be aware of what the competition is, right? To learn algorithmic trading from any of the top gurus out there, I think you'll be very surprised, if not shocked, at the amount of money you've got to pay to get onto these particular courses. You know what? I know it sounds wishy-washy, so I don't
No,
like
that's
but
fine. Does
I will.
like, is there even any competition?
Well, that's part of it, right? So there are gurus out there that are basically talking about. Let me see if I can actually find this section here. It is towards the end. I don't remember the exact time frame. No, okay, I won't waste your time. But in a nutshell, you'll find that you'll get courses anywhere from $3,000 to $10,000, and I literally show screenshots here. This is not me just laying out some baloney to you, right?
That's excellent then. So people can look at that and see what the competition is.
Yeah, and I tell you the names of the gurus and exactly how much the courses are being charged for, right? This course here, because I'm sure everyone wants to know, right? So it's basically $17.75, but based on the amount of value that you're going to get from this, and also compared through to all the other gurus, this is actually a very affordable price, in our opinion, at least based on what you're getting from someone that has a proven track record over the last 4 years. That is completely open. No one out there is actually doing that. So now is literally an open book, and yeah, the competition out there is
the videos. Is that right? These are videos mainly.
Yes. So anyone that's gone through, my other courses, it's very, very similar in nature to that, right? So largely video based. There are some, guides for things that are step by step, like how to install an operating system on a VPS and so forth. But it is very easy to follow. You don't need to be technical. You don't need to be an IT guru or anything like that. I take you through everything step by step by step, right? And of course, it's not just the course content. If there's anything that you need in terms of questions or whatever, that we've got everything from Slack communities to forums through to various other things that you can use to get help, not just from me, but from many other people that have gone through the course as well.
Are people able to pick it up?
What do you mean?
Well, you go through, you've accomplished.
To actually put into practice, you mean?
Yes.
Yeah, of course. Yeah, and obviously, if that wasn't the case, then this would not be a good course to go through, right? But again, you don't need to learn programming. You're learning from someone that has done this with a proven track record, that even on a daily basis you can see the performance over the last 4 years as well. Third-party audited, right? And step-by-step lessons from me, which from anyone that's done any of my other courses, you should know that I explain things, hopefully, fairly well, right? And an entire support of the community of, many people that have already gone through the course that can all help as well.
Excellent.
So I don't know if now it's on. Now, are you on?
Yeah.
Yes, I do.
Okay, all right.
Oh, this is Naufal. Congratulations on your accomplishment, Naufal.
Thank you. Thank you very much. Thanks for having us. It took a lot of work, a lot of backtests, a lot of data mining, but hopefully we can get value from that.
So are you enjoying, I mean, you've gone through two things. One, you've created the course. I'm sorry, one, you've created the trading, you've done all this trading development, and two, now you're involved in an educational endeavor with Ron. And are you enjoying them both?
Yes. So basically, on the educational side, Ron is really is much better than me to explain things. Me on my end, I do a lot of research, a lot of backtests. I look for samples to mine, and also I trade my own money. And this is basically what I do. I mostly trade and do research and collab with Ron, and Ron also helped me a lot. He has a lot of experience, so both of us did this course, but he's better than me definitely for teaching the theory and the practice.
Yeah, when I approached now, it was a scenario of basically saying, look, you teach me everything you know, and then I'll be the one that can, put the course together. But of course, before anything is released, now we'll validate the fact that everything is correct based on how he was showing things to me. And then from there, we present things to the community. And like I said, we've got some sessions that we've had now that comes in for like, 2 hours or whatever, just to answer any questions that have come up from the community.
I mean, I'm sure that some students can, mess it up no matter what you gave them. If you gave them,
Sure.
the actual trades, they wouldn't be able to execute. But are you finding that people are able to get profits?
Yeah, all right, let's answer that realistically, right? So if when the market is tanking, if you have long only algos, then you can expect to be making a bucket load of money from long only algos that are stock based, as an example. Okay, so as you saw from 2022, now is basically back to break even pretty much for 2022, whereas the market is still down 20%. So he's outperforming the market by 20%. That to me is a good scenario to be in, such that when the market has the rare times that it's bearish, because it is rare, right? Then you basically want to be chopping sideways, more or less. Okay, then when the market gets back to normal, then your algos kick in as well, and then the profits start coming back in. But the key is you don't want, the market to be down 50% and you to be down 50%. Obviously, that's not, great. But if you can be definitely outperforming the market during bearish periods, that's a good situation to be in. And again, if you can be chopping sideways when the market is basically tanking, I think that's a good scenario to be in.
I agree with you. I mean, you wouldn't want to, take your risk mitigation to the extent that you had no losses ever. If you do that, you wouldn't have any profits ever either.
Exactly. Right.
And Ron, there's some questions, I think, in the
Sure. Yeah, I just saw those.
Okay, please.
So John is saying, does it backtest options trading strategies? The answer is no. SQX does not do options. It is purely, think of it as raw tickers, right? So ETFs, stocks, futures, Forex are the primary things that you're going to be putting into there, not options contracts. And there's no plan for them to do options in their roadmap that I've seen. Pavik says, how small or big does one need for starting capital? That can vary depending on how many algos you want to be trading at the same time. What will happen is that you can start off with a handful of algos, say 4 or 5. Okay. And for that, you don't need to have a huge account. So you can start there and get your feet wet, right? Get used to the skills that are required on a day-to-day basis to manage an algorithmic trading platform. Then as you start building capital, or as you start building your confidence as well, then at that point you can start adding more algos and therefore growing your account out. Now, if you're in a scenario that you want to be running like Now does, where he's running, 40 or more algos at the same time, clearly you're not going to be doing that on capital of $5,000. Okay. But you can start with a handful of algos and therefore start with a smaller amount of capital. So that's number one. Number two is that these days you can, if you do want to be more aggressive in terms of having a relatively smaller amount of capital but still doing algo trading, you can trade micros. And I'm talking about futures now. As a matter of fact, you could even do Forex if you wanted to, because you can do, there's leverage there, right? But you can do small lots in Forex as well, just as you can do these days micros with futures. And that gives you the ability to have smaller accounts and still be able to, trade, let's say, half a dozen or so different algos that are all trading micros. Okay. And on that, even though you may not have seen that in the course, next month, I've unfortunately been very busy doing back-end work with my internal systems this month, but next month I'll be releasing a bunch of extra classes that will be added to the course that will teach you all about trading futures and micros, and also give you a couple of workflows within the course that you can then start applying immediately for trading micros as well. Okay. Lee says, also, is the data free to download? How expensive to get good quality data from TradeStation or wherever you recommend? Okay, so if you get the Ultimate Edition of StrategyQuant, they, like I showed you, have the ability to allow you to download data directly from them for both futures and for ETFs and for stocks. Now, that said, we found that the quality is okay, right? Not fantastic when compared to say, TradeStation. TradeStation is one of the best data providers out there from a quality perspective, and also in terms of the amount of history that you get, which is really cool. And the really nice thing is that basically, if you're signing up with them as a broker, you need $2,000 to deposit into that account, not to pay for the data, but just $2,000 to have in your account to trade. And once you've done that, the platform and the data are, you can get a lot of the stuff basically for no extra cost, right? Literally nothing.
Yeah, I, Ron, would
you
just
can get
like
for free.
to endorse that because I've been for many years using TradeStation as a data source.
Right, yeah. And now there are some countries, unfortunately, such as Canada, where for some reason the local rules do not allow Canadians to have TradeStation as your broker. If that's the case, then what you can do is that you can actually still use TradeStation, but use them as purely just a data provider. But you got to get on through to like a rental thing, which costs roughly about $100 a month for you to be able to subscribe to TradeStation just as a data provider and not use them as your broker. Okay. The vast majority of countries, you can sign up to TradeStation as your broker and therefore use them as both your data provider and your broker. And again, by simply depositing $2,000, you'll pretty much get a whole pile of data for free and really high quality. Okay. So I'd recommend that definitely as number one. So then he says, is there a data monthly payment? Typically not if you're using them as a broker. What about for options data expenses? Well, that's kind of jumping, it's a tangent kind of issue. So you can trade options with TradeStation, but it depends what types of options you want to trade. So TradeStation are a little bit weird in the sense that they don't have like a joint account. So if you want to trade equities and you also want to trade futures, as an example, you need separate accounts for those two things, different data buckets and different money buckets too, and different margin buckets too, right? Now, if you want to trade options, but options on equities, then that's going to tie in through the equity accounts. Okay. If you want to trade options on futures, not only is that a separate account, but it also is a different platform. It's something called Futures Plus that they have. Yeah. And that is not tied to their algorithmic trading platform. Okay. So you would not be able to create algos for doing option trading, as an example, especially on futures. So that's that. Does StrategyQuant support machine learning models? Sort of. So they've got a whole bunch of AI/machine learning technology that's built in, such as, all of the genetic evolution stuff and all that. That said, you don't have the ability, well, it's not entirely, I was going to say you don't have the ability to have custom stuff. Let's just say typically you won't be able to do custom stuff. That said, their platform is extensible. Okay. And you can create your own custom programmatic modules. The catch is that their platform is built on Java. So you need to know Java in order to create your own custom modules, right? But if you did that, then in theory, you could have your own custom logic that you could have as an add-on module of your own. You don't have to share it with them. It's just something you would install locally yourself on your platform, but you've now extended the functionality of what SUX can do, but again, it is Java based. Okay. Lee is saying, have you ever developed bear market strategies? Yes, we've had a look at it, and I'll be completely honest, they are absolutely much more difficult than long only strategies. And the reason for that is because you're more or less swimming against the tide. Okay. On a long-term basis, the stock markets tend to grind up. Okay. On a long-term basis, bonds tend to grind up. Does that mean they never go down? Of course not. But this is part of the reason why finding algos that are essentially swimming against the tide are tough to find, right? So that said, can you develop bear market strategies? Yes, but you just have to be willing to put in quite a bit more work and time in order to source those out. Brandon's saying on your demo video on your site, you show competition price at 125. Oh, okay, cool. So if you go to 1 hour, 25 minutes, Brandon is saying that that's where you'll see, you know, the competitors, again, pricing things up between $3,000 to $10,000, right, for something comparable. That's the end of the questions here. So, and now if you want to jump in with clarifying anything, feel free to, but that's all the questions that I can see there.
No, that's all right. That's all right. But just to add a note regarding bear market strategy, I think what I found from my research, you could, but you need to change the workflow, because the fact that a bear market is not that common, you will have to change your criteria in the number of trade needed. So you have to lower your trade. So therefore, you will have lower sample. So personally, I just prefer to probably add just a market regime. So above 200 colon, and that's it.
Yeah. Yeah. When you get into data mining, you'll find that, you know, data is gold, right? And what I mean by that is that if you think that, let's just pick a rough number. Let's just say on average, the market tends to be grinding higher or say chopping sideways, maybe 80% of the time. Okay. 20% of the time, it might be a bearish market. So now from that perspective alone, you're now vastly restricted to the amount of data that you're data mining, because you're only looking at 20% of your entire data set that fits during bearish periods. Let's say that you're using a filter, right, to only look at bearish periods. So that's part of the reason why it's so difficult, right? Because just the amount of data that you've got access to is so small compared through to the long only style strategies that you can get. And the more data that you throw at SQX, the more likelihood that you have of finding something viable and something robust. Okay. So yeah, there's multiple reasons why it is tough to get good bearish only strategies. Okay. But that's part of the reason as well. Brendan's saying, have you seen any general outperformance from StrategyQuant in FX versus equity versus futures? Okay, so to understand the history there, StrategyQuant was originally a Forex platform, and you'll see various signs of that when you look at things. So for example, they talk in pips and all that kind of stuff still, right, within the interface. Later on, they then evolved in through to equities and futures. So we currently are focused on equities and ETFs. Again, next month, I'll be adding lessons on trading futures. And that I think is really nice, because now you can get into stuff that is very, very uncorrelated or even negatively correlated with the market, right? So think of things such as, you know, energy, which has been going through the roof when the market has been tanking, you know, nice negative correlations there, but even stuff that just has nothing to do with anything. So think of things that, such as, you know, live cattle, think of things such as, you know, soybeans, coffee. People still want their coffees, even, you know, regardless of what the market's doing. So it's nice to be able to do that. And also there's a bunch of futures that tend to, even though that they might be, even though they might tend to trend, they actually trend in both directions. So it's not like stock markets that tend to, you know, 80% of the time basically grind higher. You've got futures markets that are much kind of choppier, if you want to put it that way, right? Rather than just essentially going bottom left to top right. And those are much more interesting and much more viable to have long and short algo based directions, as opposed to really just sticking to long only, right? So quite a lot of variety can be added through to your algos by, you know, tapping into futures. Lee says, really hope StrategyQuant can support options. That would be a whole new chat. Yeah. I don't want to pop your bubble, but I'll pop your bubble. Don't hold out hope for that at all, right? They have no plans, no roadmap for doing that at all. Okay. If you want an options backtester, there are various players in the market. You saw Rocco present some of those. I agree with him that MesoSim is one of the current most advanced products out there, which can do a lot, okay, and fast. So, you know, give those guys a shot as well.
Ron, can I jump in a second?
Sure.
Yeah, so regarding option trading, something that I do in my personal account, you can combine algorithmic signal with option trading. So for instance, if you develop an algorithmic on Apple that trade on a daily bar and you have a signal to go long or short, you can just take the trade with option. It's often a better way, especially if there's earning, your loss is limited. You can just take a simple trade like vertical bull call or bull put to trade the option to combine.
So just to kind of expand on that, let's say that you want to trade volatility products, right? Volatility ETNs. And, let's say it's VXX. And, can you potentially go long or short some of these volatility ETNs? Sure. But you better get prepared for potentially wild rides. Okay. So if you're in a situation that you say, well, I want to be able to, short vol ETNs, one of the interesting ways to do that is just with a simple vertical, right? So in other words, a bearish vertical, okay? That is going to, yes, it's going to limit how much money you can make, but it's absolutely then going to limit how much money you can lose. And that's the key. So what Nara is saying here is that you can develop or use SQX to develop an algo, even for volatility ETNs, but then you're manually trading the signals that are provided through this SQX technology. Because remember, SQX finds the algo, it then gives you the code, the easy language code that you can then put into TradeStation and multi-charts. Once it's in there, you're now getting live signals saying the algo right now wants to go long or the algo right now wants to go short. When you see that, and you can set up email alerts and that kind of thing too, but when you see that, what now is saying is that he can then go in and put on an options trade that basically is a proxy for a directional trade, let's say shorting vol. Okay, but he's doing that with something that is going to limit his loss. And therefore, you greatly reduce the risk that you can, potentially then have volatility go through the roof and you get killed if you're trying to short it, right? And similarly, you can do the same thing for anything, for trading, stocks or whatever, right? You might say, I still want to go long even during earnings, but I don't want the risk. So therefore, I'm going to just do an at the money vertical that's in the same direction as what the algo is telling me that it should do. Right. But just be clear on the fact that even though you can do that, SQX itself will not data mine options contracts. Okay. Which is what the original question was saying. So they don't have any plan to do that. They're going to stick through to standard underlyings of ETFs, stocks, Forex, and futures. Okay. John is saying, what was the name you just said for the options backtester? Okay. It's called Delta Ray Mesosim. Okay, so look at, I can grab the URL if you want, Delta Ray. So go to deltaray.io, and then from there, you'll be able to sign up.
Deltaray.io. We'll have to look into that.
Yeah, no, it's as a matter of fact, the guy that created it is part of my community. But it really is one of the best, most powerful options backtesting, automated options backtesting systems on the market right now. So,
well, that seems to be questions for now. For tonight, I think we really appreciate both of you now and Ron both taking so much time. We wish you the very best of luck with the course. And it sounds like it's filling a vacuum that probably a lot of people could make good use of.
Yeah, it's a good way to dip your toe into the algorithmic trading space, because again, not needing to learn how to code, I think, is a big advantage just by itself.
Yeah, there's room for all.
Yeah.
Room for both approaches, and there's a heck of a lot of people in our group who are not programmers. Yeah,
and later on, when you do decide to learn programming, there's obviously ways that you can combine those two things together, right? So, yeah. But but thank you for having us on, and it's been good to
let me stop this recording then. Thank you very much.
Sure thing.
And let me just stop that.